We're going to talk about reading an illustration. It's one thing to see an illustration, it's another thing to have an idea of what you're looking at. So today I have a page out of an illustration. Illustrations are usually several pages long, and we want to see all pages, but I'm just going to show you, we're mostly going to look at this page and a little bit at a second page. Now, illustrations do not usually have a big black bold block on them. Instead, they have the company logo, but I'm not here today to promote any particular insurance company. I just want to talk about how to read an illustration. At the top of this illustration, we have usually the name of the person. Here we just had male. And then you have the rating you think they might be by this person's height and weight and health presentations. We thought they might be standard, but the insurance company is going to do underwriting. There's going to be labs. There's going to be a look at health history, family health history, doctor records if needed, and they're going to tell us whether this client might be preferred, or maybe there's something else between preferred and standard. Maybe this person is going to be standard. Maybe it's going to be substandard. If this person is a pilot or does frequent scuba diving, depending on their kinds of dives, if they're a rock climber, that is going to affect this. The underwriter will tell us how. Once we have this actual rating, then we'll know exactly how the numbers turn out. But while we're talking and looking at this, we want to at least start somewhere. So we're going to start with standard. And this is a male, and most states have male or female. We need to designate. There's at least one state where it's unisex, but females tend to live longer than males, and so males have to pay a little bit more for their insurance. So if a male and a female are each paying equal amounts, the female is going to have higher coverage than the male. And this particular male, we have him as age 30. Now, he may not actually be 30 at this time. He might have his birthday coming up, his 30th birthday, but insurance company always goes by the age you're closest to. So if he's closest to his 30th birthday, it's going to say age 30. And this fellow, let's call him Brian. Brian's a non-smoker, and he doesn't use tobacco of any kind, no cigars, no chew, nothing. So he's a non-smoker. And if he was a smoker, all these numbers would be quite different, be quite lower. And we have to reflect that. Now, the initial death benefit purchased by this policy is $324,945. And we are going to talk about that more later, I will guarantee you. Also, because he's buying a participating whole life policy, he has the opportunity to earn dividends from this company. Anytime the mutual company makes a profit, they share with their policyholders. And because he has a participating whole life policy, that means he gets to share in the dividends of the company. And we are going to choose for that to purchase paid up additions. Now, he could choose to receive that money in cash, but we're going to choose for it to be paid up additions that he receives for that. And then his first annual premium, we've been talking to Brian. He has saved up $10,000. He knows he can save up $10,000 by next year for his premium. So he wants to pay $10,000 on an annual basis. Now, if something goes awry, he's paying $10,000, and next year he wasn't quite able to save up the whole $10,000 by the time it was due, that's fine. He can switch to a different mode. Also, if Brian had not saved the $10,000 and he wants to start saving on a monthly basis, then we're going to show him a monthly premium amount, and we're going to choose, whatever that is. Maybe it's going to be, $865 a year, whatever or a month, whatever he wants to work that out to be, we can do that. So the illustration I'm showing you today is reflective of choices Brian has made, and it's reflective of this age 30. It's reflected of standard health, and that he is a non-smoker and a male. When we and we're looking at the tabular details page, and if I had attempted to show you this entire page on this screen, you would be not able to see all the numbers. So I didn't want to do that. And so I'm going to show you that we do have the rest of the pages here. We've got through year 10 of the contract here. So let's go down. I'm going to erase this and we'll go down and look at the next page. I still have the header up here, and we have year 1 through 30, age 31 through 60. And now let's go down even further. Here you can see we're at the bottom of the page. And here's where it tells us this is page 7 of 9. Now, different companies might put it over here. They might put it over here. But when you're really looking at an illustration, you want to see all pages. For the purpose of this video, I just want to go over the numbers because this is the particularly challenging part to understand. And so we're just going to look at a couple of the pages. But normally you want to see all those pages. And then we're going to go to the next page. This is actually this would be page 8, the last one, which is page 7. And we have it through year 60. But it does continue. It goes till this policy is 91 years old, and dear Brian, is 121 years old. Now, if Brian is still living at this time, they're going to pay him his death benefit. Just write him a check because the policy is matured at that point. Insurance companies used to go by age 100, but there were so many centennials living, they did have to change their CSO tables. So let's go back up to that first page that we were looking at, and now let's see how this information translates into the information down here. Now in year 1, oh my goodness, look at Brian's age. Now we have age 31. The reason for this is Brian will have attained age 31, insurance age 31, by the end of this first year. And he's going to pay his $10,000, and he is going to get a death benefit of $362,081. Look back up here. Didn't we have a different figure? Well, we sure did. But we also have what you didn't see, and if I would have shown you page 5 or 6 of this illustration, you would have seen this, but I didn't put it here, so let me just tell you about it. He has an optional rider on his policy. And this optional rider is a paid up additions rider. And what that rider does is it buys what happened there? What that rider does is buy paid up insurance. So of this $10,000 that he paid, I know that $3,064 bought this base premium of $324,945. This rider, on the other hand, bought a little bit of insurance. It bought some paid up insurance, and we see that right down here. Paid up insurance. And when we add this $324,945 and $37136 of paid up insurance, we come up with this total of $362,081. Now that you see that, that's not so confusing. Let me tell you what else this rider did. Not only did it buy a little bit more insurance, it also provided cash value in this policy. You see, normally a whole life policy has no cash value in it. So Brian could have paid just a straight $10,000 for this policy, and he would have had a much higher death benefit, about 3 times higher. But he would have no cash value. He would not have cash value for many years. And when he did start in cash value, it would just be very small amount to the proportion of money he had paid here in his premium. So by putting that paid up additions insurance rider on there, he got some paid up insurance bought him a little bit of death benefit, but also gives him cash value with the company. Now, when he has cash value, then he can start use the policy to borrow from that cash value and to use, like we talk about in the perpetual wealth code. Now, the second year of the policy, he also pays $10,000. His cash value increases, and by the way, this is cumulative. It wasn't $6,600 the first year and then an additional $13,000 the second year. No, it's cumulative. And I like to think about this cash value as kind of like equity in your house or as a line of credit at your bank. You have a certain amount of line of credit. In this case, the second year, he has $13,000 of line of credit. If he's already borrowed $3,000 out of that, well, then he only has about $10,000 available in the line of credit that he can be using. And of course, as you pay back that line of credit, then you can, the amount that you have access to again increases. But every year when he pays, he's going to get an increase. Then in the third year, he also pays $10,000, and now he has $21,637. In the fourth year, we did something different here, and this is how we structured the policy based on Brian's needs. Now, Brian told us he wanted the maximum cash value he could get. He wasn't so concerned about how much death benefit that bought him. He wanted the maximum cash value. So we noticed that if Brian just pays $3,064 this year, look at what his cash value increases by. I went from $21,637 to $25,000. That was actually a gain of $3,439. Do you notice that that is more than what he put in that year? That policy is being very efficient for generating cash values. He doesn't even need to use that paid up additions rider after year 3 in order to really get those cash values to increase. That's cool. Now, notice also that when he stopped paying that rider, his death benefit didn't keep increasing. It was guaranteed then never to go below this $432,617, but it didn't show an increase. I'm going to show you how it most likely will increase. But even so, if when Brian decided to purchase this policy, if he decided $362 was not enough to cover his family, then we're also going to look at getting him a term policy that's going to be convertible to whole life later on, because very inexpensively he can buy that term policy and have a lot more death benefit and still have the maximum cash available to him. Because as you would see, he would have to put, if he wants another $500,000 in this, it's going to, of death benefit, it's going to take a lot more premium, and that may not be able to be budgeted. I know it wasn't budgetable in Brian's case. So we're going to be strategic about how we use this. Now, we've been talking about the guaranteed values of the policy. Now we're going to go to the non-guaranteed. That's going to be fun to talk about, but let's first clear our board, and then we won't get confused about all the numbers and figures we have on there. So the non-guaranteed side of the policy, one of the reasons that I like you to have all pages of your illustration is because this particular company divides these two sides, the guaranteed on one side, the non-guaranteed on the other side. Other companies will show just guaranteeds on one page, and then other pages following have the non-guaranteeds. Well, sometimes they only receive the non-guaranteed numbers, and those numbers get to looking quite different. And if they're basing their decision on something that is non-guaranteed, that's a bit more risky. And I'll just tell you right now, let's talk first. What makes these two columns or two sides of the page different? The difference between the guaranteed and the non-guaranteed is this right here. It's the dividend that you're going to receive and the dividend option. Remember, we had to choose the dividend option to pay purchase paid up additions. That means when our dividend gets paid, then it buys paid up insurance. And what I was going to say earlier is that the insurance companies project their dividends. They make projections because, you see, no company knows how profitable they're going to be in a year. They're just making projections. What actually comes out can't be told until it's done. And so some companies, like this particular one that is nameless, it does a very good job of making their projections. And we see that their dividends, if not quite there, sometimes they're very close to it. Sometimes they exceed it too. So that's exciting. But I have seen other companies who do not do a good job of projecting. They make overinflated projections and they do not deliver. And if somebody is basing their decision on that kind of a policy, that's very dangerous. So even if you're comparing two policies, some people get into comparing different illustrations, I would encourage you to always go by the guaranteed values, because that's comparing apples to apples. If one company bases their dividend projection on, they strictly follow the guidelines for basing their projected dividends, and another company doesn't, and you're trying to compare these non-guarantees, you could be the loser. I don't want that to happen to you. So anyway, here's the dividend. This company believes they're going to pay out $137 of dividend. Notice the maximum paid up insurance here versus the maximum paid up insurance here. That's because of the dividend column. The dividend is buying paid up insurance. Now, what happens when you actually get a dividend paid to you? You're not taking cash, you're getting it to buy paid up insurance. Then this number has to now be the basis for the guaranteed side, because now that it's been paid up, it's part of the paid up insurance. So after your first year, after you get a dividend, all these numbers are going to change. They're going to get better. They can't ever get worse because it's guaranteed. So this is the least performance of your policy. The non-guaranteed is showing you what might happen according to these dividends. When the dividend does get paid, it comes over here. So a dividend might be paid for 3 years. Let's say 1 year. Well, in most companies we represent, they've all been paying dividends for a really long time, consecutive years. But let's say they just didn't meet it and it was lower. Your guaranteed value is still going to go up, and they can't take away any of the value you've already gained in a dividend. So I think we've gone over most of the parts of tabular detail. Let's just do a quick review. We have the personal information of the client up here, the age and the sex and the health, whether they smoke or not, is going to, and then what amount they select for premium, whether it's annual or monthly, is all going to affect what amount of death benefit that purchases. And when we decide on the premium, we're also going to get that paid up additions rider. And so when we pay the premium, you're not only going to have cash value, you're also going to have a death benefit, and you're going to have some paid up insurance. You also have the opportunity to earn a dividend. So you have a death benefit. You also have money that you can use in the perpetual wealth code. And when you take a loan out, you're not borrowing your own money, you're borrowing the insurance company's money. And so you're continuing to get the guaranteed growth and continuing to get the options to have the earning of dividends, even though you have a loan out. So I hope this has been helpful to you in determining how to read a policy. Always make sure you get all policy pages of the illustration you're looking at. And if you have any questions about the illustration, even that you've been shown by another agent and want to talk about it, we're happy to help you.